Well, what was striking about this market was with the speed with which everything moved. Many of us went through '08 and thought that was rapid, but everything moved quite quickly here. Markets locked up fairly quickly, including markets that one assumes always work, such as treasuries. But what was also striking was the speed with which both the market participants and the regulators worked. And I can't praise the regulators enough, particularly the Federal Reserve, the ECB, in terms of how swiftly they worked here to help to unlock markets.
Ron, I know a lot of your clients are obviously in mutual funds and all sorts of retirement accounts. Can you give us a sense of the sentiment out there that you're getting from retail investors, how fearful they are, whether they've been buying or selling, and where that has gone as this crisis has evolved?
Well, depending on how they're invested. So if an investor is in a 401k investment, those tend to be in target date funds, which basically are self-correcting. So most participants aren't doing anything with those, which is good. That means that they're buying equities when they're low and selling bonds when they're high. So they're doing the right things. In terms of how it's been a little bit different. I mean, this has been a little bit frightening for them, and there was a fair amount of selling, although not anywhere near as much selling as we saw back in 2008, probably because of the speed with which this has moved. I mean, if you think about how markets tend to move, particularly those that are associated with any kind of recession, the market tends to take a whole lot longer to recover than GDP does. This is uncharted territory for us. First of all, it's not a typical recession. This is first and foremost a public health crisis that in turn has caused an economic crisis, which in turn has caused challenges to the financial markets. So as a result of that, there's no playbook for people. And I think for the most part, retail investors have stayed put.
Ron, you're one of the 8 GSIBs, globally systemically important banks, and therefore also one of the 8 members of the Financial Services Forum. And you, along with the other 7 members, the nation's biggest banks, decided collectively to suspend your buybacks a few weeks ago. I'm interested to hear from you exactly how that unfolded. I mean, did the Fed push you to do it? Did the 8 of you happen to come together and just make the decision? How did that all come together?
Yeah, well, we all saw what was starting to happen in the markets. This was in early March. And while we couldn't predict what was going to happen, we knew that oftentimes crises get worse because of lack of confidence. So what we wanted to be sure was that there was no question that there would be plenty of capital to lend into the system as we come through this and into a recovery. And so the feeling of all of us was this would be a very important symbol. In some ways, it's unnecessary because these banks are extraordinarily well capitalized. I mean, if there's one thing that's worked in the 12 years since the crisis, it's been the repair of the banking system and the recapitalization and the strengthening of the banking system. But it was a very important symbolic action that we thought would be even more effective if we took it collectively.
Well, despite the strength and perhaps the lack of need to do it, there's still been a lot of debate, Ron, about whether dividends should also be suspended. In fact, on our air in the last couple of weeks, we've had some high-profile bank CEOs commit to their dividend, and then also former Fed Chair Yellen suggests she'd like to see the banks suspend their dividends. Let's just recap some of those interviews.
From our perspective, our dividend is sound, and we plan on continuing to pay it.
The recipient of the dividends are many times small individuals who own these very large bank stocks all over the country. To lose that income at this time, I happen to think would be a very poor thing to do.
We're in a position to lend to our clients, but it's my expectation we'll continue to pay our dividend.
I would be in favor of asking the banks to suspend dividends and stock buybacks.
Where are you on that debate on dividends themselves, Ron? Should the banks and yourselves go one step further to be extra careful to preserve capital?
Listen, the reason that there'd be a suspension in dividends is if one, you thought there was some kind of solvency issue with the bank, or two, if you felt like it was impairing the ability to lend into the market. And neither of those are true. The average dividend at most banks is around 30% of capital distribution. So it's a relatively small part of what goes back to shareholders relative to buybacks. And also, it's paid out 4 times a year. Right now, there's absolutely no need. There's plenty of capital flowing into the markets, and these banks have plenty more to lend. So I think this is something that we should watch. But right now, we see no need to stop dividends.
Ron, just want to pivot back to the core business, the asset management business. Do you think the volatility we've seen in the last couple of weeks will give another push back to active management? Will various clients look at what's happened and think, I'm done now with that automated stuff with various ETFs, and I want to go back to an actively managed portfolio?
Yeah, it could, and particularly now as the economy recovers, and there will be a recovery here, but there'll be some that will come out quicker than others. Not all hospitality will recover at the same time. Not all airlines likely recover at the same time. So it probably is a good time for active management. But I also think what we need to look at, too, is we need to look at why liquidity wasn't going to markets. And in many cases, particularly some of the fixed income markets, there really isn't enough liquidity in those markets. So that's something else that we need to look at and figure out, is there a change we want to make going forward? And again, going back to my point earlier about the Fed, I think the Fed anticipated this. I think they recognized that one of the changes that had occurred between last time and this time was that through the new Dodd-Frank rules, the strengthening of capital, there was just less capital available for market making. So if you look at the programs that the Fed came up with, they were very much designed to make up for the fact that there wasn't liquidity in those markets. So again, I can't emphasize enough how well they've done. Oftentimes, you find you're fighting the last war. In this case, they were definitely fighting this war and doing it well.